Imagine the entire world owing $348 trillion in debt. That's more than 3 times the size of the entire global economy. And the scary part is, the system only works if the debt keeps growing forever.
So what happens if the growth suddenly stops?
Today, governments, companies, and households across the world are borrowing money at a record pace. Countries borrow to run their economies. Businesses borrow to expand, and families borrow to buy homes, cars, and education. Debt itself is not necessarily bad. In fact, borrowing money can help economies grow faster. Governments use debt to build infrastructure. Businesses use debt to invest in new projects. Individuals use debt to buy homes or start companies. When used responsibly, debt can create growth and opportunity.
But there's a problem.
Over the last few decades, global debt has grown at an astonishing pace. In the year 2000, total global debt was around $100 trillion. Today, that number has reached a record $348 trillion. That means debt has grown much faster than the world economy itself. And when debt grows faster than income, the system becomes fragile. Governments want economic growth. When growth slows down, they often borrow money to stimulate the economy. They spend on infrastructure, social programs, or economic stimulus. In the short term, this creates jobs and boosts spending. But it also increases debt. For many years, borrowing money was extremely cheap. Central banks around the world lowered interest rates to stimulate economic activity. Cheap money made it easy for governments, companies, and households to take on more debt. As long as interest rates stayed low, the system seemed stable. But that stability may not last forever. When interest rates rise, the cost of maintaining debt increases. Governments must spend more money simply paying interest on their loans. Businesses face higher borrowing costs, and households struggle with higher mortgage and loan payments. Suddenly, the debt that once fueled growth begins to slow the economy. Debt has quietly become the engine of the modern economy. If debt grows too large compared to the economy, it creates financial risks. Investors may start questioning whether borrowers can actually repay what they owe. When confidence disappears, financial crises can happen. History has shown this many times, from sovereign debt crises to the global financial crisis of 2008. Excessive debt has often been at the center. The modern global economy is built on one powerful assumption, that the future economy will always be bigger than today's economy. As long as economies keep growing, debts can be repaid or refinanced. But if growth slows while debt keeps rising, pressure begins to build inside the system. The $348 trillion question. Today, global debt has reached historic levels, more than $348 trillion. That number continues to rise every single year. The system continues to function because growth, borrowing, and refinancing keep it moving forward. But economists around the world are increasingly asking one question. What happens if global debt keeps growing, but economic growth slows down? Because when a system depends on ever-increasing debt, the real risk isn't the debt itself. The real risk is what happens when the growth finally stops.